Have you ever stopped to think, I mean, really think, about what your retirement might look like, say, decades down the line?
It's a big question.
It is. And what if we told you that future might actually involve assets like Bitcoin or maybe Ethereum, taking a strategic place right there in your portfolio?
Yeah, for a lot of people, that idea,
Yeah,
it probably sounds pretty radical.
right. The whole concept of, volatile digital assets sitting inside a traditionally conservative 401k, it seems, well, not just revolutionary, maybe even a bit unsettling.
Absolutely. Contradictory, even.
Yeah, contradictory to almost everything we've been taught about playing it safe for retirement.
And that reaction, that initial sort of hesitation, it's completely understandable. This isn't just adding another line item to an investment menu you get from HR.
No, it feels much bigger.
It is. It really signals this a fundamental shift, a really profound one, in how we approach long-term wealth preservation and growth, too.
So blending the old and the new.
Exactly. Blending the established, often risk-averse framework of retirement funds with this disruptive, fast-moving world of digital assets. It's a complex intersection, no doubt.
And it definitely challenges conventional wisdom.
It does.
Yeah.
It pushes us to rethink what safe actually means and what growth means for the next generation of retirees.
That's a really profound point. And, it brings us right to our mission for today's deep dive.
Okay.
We're going deep into whether cryptocurrency, especially the big ones like Bitcoin and Ethereum, whether they should really be a part of retirement portfolios, like your 401k.
Is the big question right now.
It is. We'll peel back the layers, look at the big questions driving this whole debate, really dissect the arguments on both sides.
The pros and the cons.
Exactly. And ultimately, help you understand what this could genuinely mean for your financial future, whether you're, years away from retiring or maybe it's coming up pretty fast.
Right. And to do that, we've pulled together a pretty wide range of sources, haven't we?
We have. We've got insights from industry roundtables, like Seeking Alpha published some interesting ones.
Yeah, and official press releases, too, from
Yeah.
major, trusted players. Fidelity, for example.
Can't get much bigger than Fidelity.
Yeah.
And we'll also dig into the regulatory side, the guidelines from the Department of Labor. That's critical.
Super critical. Plus, we've got in-depth research from some top crypto-focused firms. Think CoinShares, ARK Invest.
The ones really tracking this space closely.
Exactly. So our goal here is really to pull out the most important nuggets of knowledge, the key insights, and give you a really well-rounded, impartial view.
Actionable, hopefully, too.
Yes, actionable perspective on this landscape, which, let's face it, is changing incredibly fast.
Okay, fantastic. Let's get ready to unpack this. But just before we dive in fully, a quick note.
Yeah.
If you're finding value in these deep dives, if they're helping you make sense of all this stuff.
Which we hope they are.
We do. Please take just a second to like this video, subscribe to the channel if you haven't already, and maybe hit that notification bell.
It really does help.
It genuinely does.
Yeah.
Your engagement, liking, commenting, sharing, it's actually incredibly important for us. It helps the channel grow. It boosts visibility in the algorithm.
Lets other people find this content too.
Exactly. And most importantly, it lets us keep making this kind of deep dive content for you, tackling these really compelling, sometimes complex subjects in finance and tech.
So yeah, we genuinely appreciate the support. It makes a difference.
It really does. Thank you. Okay, section 1. Let's get into the core question. So let's tackle the fundamental challenge head on. The thing that underpins this whole discussion.
Right.
As you see in those industry forums, the Seeking Alpha roundtable you mentioned, it boils down to that classic financial dilemma, doesn't it?
Risk versus reward.
Always, always. On one side, you've got the volatility. I mean, well documented, sometimes just breathtaking how much crypto prices can swing.
Oh yeah. Whiplash is a good word for it.
Right. We've all seen the headlines. These assets can move, 20%, 30%, maybe even more in a single day sometimes. Forget about a week or a month.
Yeah, it's not for the faint of heart. But then on the other side, you have this really compelling, almost irresistible long-term upside potential.
The potential reward part.
Exactly. And it's not just, random speculation anymore. You've got a growing number of individuals, yes, but also sophisticated institutional investors. Even corporations are seeing this potential in assets like Bitcoin and Ethereum.
So the big money is noticing.
They are. Now, this risk-reward debate, it's not new in finance, right? We've seen it with emerging markets, high-growth tech stocks, even commodities.
Sure.
But applying it to retirement accounts, specifically 401k, That adds this whole new layer of complexity.
Why is that? What makes 401k so different?
Well, it's because of the ingrained purpose of these funds. Almost sacred, you could say.
Capital preservation.
Capital preservation, absolutely. And stable, predictable growth, ideally for decades. Your retirement fund isn't just another investment account.
No, it feels different. More important.
It represents your financial security, hard-earned security for your golden years.
Yeah.
So any potential risk in that account feels profoundly personal, much more so than, say, a speculative trading account.
That psychological dimension you mentioned, that's absolutely critical, isn't it? This tension between, maybe hitting it big versus potentially losing a huge chunk.
Right.
It directly hits your comfort level.
Right.
And that, in turn, affects your potential outcomes. I mean, how much risk really is too much when it's your retirement security on the line?
It's a million-dollar question, or maybe the multi-million-dollar question,
Yeah.
depending on your portfolio.
Exactly. It's not just about a temporary dip you can write out in a brokerage account. This is money you might actually need for living expenses, for healthcare, or just peace of mind, yeah.
Yeah.
In 20, 30, 40 years, the stakes feel completely different. It demands a really, really careful calculation.
Absolutely. And that decision, it isn't purely mathematical, is it? It's not just about looking at spreadsheets with projected returns or risk metrics.
No, it feels much more emotional than that.
It's deeply psychological, like you said. Financial models might show, okay, adding crypto gives you a better theoretical risk-adjusted return.
Yeah.
But actually seeing your retirement balance drop by 50%, maybe more, in a bad year.
Oof. Yeah.
Even if it eventually recovers years later, which historically it often has, that can be incredibly distressing, gut-wrenching, like you said earlier.
And that distress could lead to bad decisions.
Precisely. That emotional toll could, paradoxically, make someone panic. Sell at the absolute worst possible time, right at the bottom, locking in those huge losses.
Turning paper losses into real ones.
Exactly. So really understanding your personal comfort level, your true tolerance for that kind of volatility, that's paramount when we talk about putting these assets into long-term, absolutely critical savings vehicles like a 401k.
It takes a certain mindset.
It requires a calm, long-term perspective that, honestly, many people find really difficult to maintain when the market's crashing around them.
Okay, so that's the core tension. But here's where I think it gets really interesting. Why now? Why is this specific question about 401k bubbling up with such intensity right now?
That's a great question.
It feels like it's more than just, hey, let's add another investment option. It seems to signal something bigger, a more fundamental shift happening, don't you think?
I absolutely do. If crypto really starts entering retirement accounts widely, like in an integrated way, that signifies a profound shift, maybe even an irreversible one.
Okay, why irreversible?
Well, think about it. It's not just another investment product popping up. It represents mass adoption, but in a way that goes beyond even the existing vehicles like crypto ETFs.
Which were a huge step, obviously.
Monumental. The spot Bitcoin ETFs.
Yeah.
Huge step. That provided regulated easy access. But 401k inclusion, that represents something much deeper.
How so?
It signifies this level of institutional acceptance, integration into the very bedrock of personal finance. The plumbing, almost.
A stamp of legitimacy.
A huge stamp of legitimacy, one that few other vehicles can really provide. This isn't just speculation anymore. It's a clear move towards mainstreaming what used to be a fringe asset class.
So it's not just about what's available, but how it becomes available, and maybe who is offering it.
Exactly. ETFs are pretty straightforward, right? You buy and sell them in a standard brokerage account. Relatively easy.
Yeah.
But 401ks, they often involve your employer sponsoring the plan. There's the inertia of payroll deductions just happening automatically. Deep integration with HR systems, financial systems.
It's embedded.
It's deeply embedded. The fact that a major plan administrator like Fidelity that we mentioned is even considering this, let alone offering it, that implies a much more fundamental acceptance, a much bigger stamp of legitimacy.
Okay, so what does that profound shift mean for how crypto is perceived? By you, the listener, the everyday investor. By the general public.
What could be huge?
Does it finally move from being this niche kind of speculative thing to being seen as a recognized, maybe even expected part of a traditional retirement plan?
That's the potential trajectory, absolutely. It transitions crypto from being an alternative investment, something you have to actively seek out, research yourself.
Do your own homework on.
Right, to potentially becoming a standard option that's just presented right there alongside your traditional mutual funds, your bond funds, your target date funds.
Wow.
That psychological shift, just seeing it offered by your employer, With that implied regulatory oversight, it's immense. It moves crypto from the financial fringes right into the mainstream conversation.
Affecting millions.
Millions of everyday working people who might otherwise never have touched these assets. It's about normalization, making the unfamiliar feel, well, familiar, and hopefully building broader trust over time.
Okay, normalization. But who's actually pushing for this change? Is it the providers? The investors?
Well, we're definitely seeing a pretty clear generational divide here, aren't we?
Seems like it. Younger workers, right? People maybe early in their careers, 20s, 30s. They seem increasingly vocal about wanting crypto exposure in their retirement accounts.
They are. Many of them grew up with digital assets. They kind of intuitively get the tech. Maybe they've seen or even participated in some of those explosive growth cycles.
They're comfortable with it.
They're more comfortable, generally speaking.
Yeah.
Whereas older investors, well, quite naturally, they tend to prioritize capital preservation, stability,
Makes sense. Shorter time horizon.
shorter investment horizon. They've already accumulated wealth they need to protect. Their focus is often on safeguarding what they've built, not necessarily chasing high growth, high volatility assets anymore.
So this creates a tricky situation for the 401k provider.
An incredibly interesting dynamic, yeah. They're kind of caught in the middle, trying to balance the demands of these very different age groups.
With different risk appetites.
Hugely varying risk appetites and financial goals, often within the exact same retirement plan structure. It's a delicate balancing act.
How do they manage that?
Well, they have to offer choice, but without accidentally encouraging people to take on risks they don't understand or can't handle. Especially given the fiduciary duties tied to 401k, they have a legal obligation to act in participants' best interests.
It's like that marathon analogy you used. The younger runner going for a personal best, taking risks.
Right, willing to push the limits, explore new training methods. That's your younger investor focused on growth, tolerant of risk, seeing that long road ahead.
Versus the seasoned runner who's done it before.
Exactly. They just want a steady, predictable pace, finish comfortably, enjoy it, avoid getting injured. That's your older investor prioritizing preservation, stability, a reliable finish line.
Completely different mindsets for the same long-term goal. Reaching retirement securely.
Precisely. So for the plan providers, it's a real strategic challenge. They have to figure out how to cater to both.
Which might mean
Often leads to discussions about maybe offering tiered investment options, definitely enhancing educational resources, providing super clear risk disclosures.
making sure people know what they're getting into.
Exactly. Give people options, but don't push less informed participants into investments that are unsuitable for their risk profile, all while navigating this really complex regulatory landscape.
Okay, speaking of regulations, this isn't just about what investors want, is it? There are powerful government bodies weighing in, sometimes pushing back quite hard.
Oh, definitely. The Department of Labor, for instance, they've raised very significant concerns about putting crypto in 401k,
Setting risks.
citing substantial risk to participants.
Yeah.
They are clearly trying to look out for the average American's retirement savings, which they see as this, sacrosanct pool of long-term money.
And what are their specific worries?
Well, rightly so, from their perspective. Their official guidance highlights several key things. The speculative nature of crypto, obviously, the extreme price volatility we've talked about, the challenges in accurately valuing these assets, especially for fiduciaries who have that legal duty to act in the participant's best interest. How do you value something that swings so wildly?
Good question.
They also point to potential fraud risks, theft risks, and just the general, nascent and sometimes unregulated aspects of the crypto market. Their stance is basically a big blinking caution sign.
Telling plan fiduciaries to be extremely careful.
Exercise extreme care, yes. And really consider if these assets are suitable for retirement savers, many of whom might have limited financial literacy when it comes to complex digital assets.
Okay, so you have this powerful government body saying, whoa, slow down. This looks too risky for retirement funds.
Pretty much.
And yet, despite those clear warnings from the DOL, you have some major industry players like Fidelity actually pushing ahead, exploring it, even implementing options.
That's right.
That push, despite the regulatory concerns, seems really significant. It signifies a deep conviction in this asset class, doesn't it? Almost like a standoff.
It really does highlight that classic tension you see so often.
Yeah.
Innovation versus protection. The industry's conviction, it's not just about chasing the hot new trend or generating fees, though that might be part of it for some. Often, it stems from a fundamental belief in the underlying technology blockchain and its potential to disrupt and improve traditional finance.
They see the long game.
They see the long-term growth trajectory of digital assets and argue, hey, if we completely exclude these, future retirees might miss out on significant, potentially portfolio-enhancing returns.
So it forces a tough question.
It forces us to ask whether our existing regulatory frameworks, which were built mostly for stocks, bonds, traditional stuff, are they agile enough? Are they comprehensive enough to handle these rapidly evolving digital assets?
In a way that protects investors.
Protects investors, absolutely, but without totally stifling beneficial innovation. It's a really complex policy challenge with no easy answers right now.
Okay, so we've got this swirling debate, generational differences, regulatory pushback, but let's bring it down to earth. What does all this practically mean for you, the listener, the long-term investor planning for retirement?
Right, the bottom line.
Yeah. The research actually suggests something pretty compelling. Something that might surprise you, actually, given all this talk about extreme volatility.
It is fascinating. When you look at the portfolio allocation models, the math, what emerges is that for long-term investors, even a very small strategic allocation.
How small are we talking?
We're talking really small, maybe just 1% to 5% of your total portfolio allocated to foundational assets like Bitcoin or Ethereum.
Okay, 1 to 5%, not exactly betting the farm.
Not at all. But even that small slice, according to these models, could potentially significantly enhance your overall portfolio performance over the long run.
Enhance how?
By improving risk-adjusted returns. These models compare crypto's historical performance, its correlation or often lack thereof, with traditional assets like stocks and bonds.
So does it move differently?
Often, yes. It has historically shown low correlation to traditional assets, which is the holy grail for diversification. Studies, like those from CoinShares you mentioned, have shown that adding a bit of crypto to a standard 60-40 stock-bond portfolio.
The classic balanced portfolio.
Exactly. Adding that small crypto slice could lead to improved risk-adjusted returns over various long-term periods. It's not necessarily about making your portfolio drastically more volatile overall, but about strategically diversifying to capture unique return potential that traditional assets might lack.
Okay, you keep saying risk-adjusted returns. You mentioned the Sharpe ratio earlier. Can you break that down simply for folks who aren't, finance nerds? Why is that important here?
Sure. Basically, the Sharpe ratio measures how much return you're getting for the amount of risk you're taking. Think of it as bang for your buck, risk-wise.
Higher is better.
Higher is better, yes. A higher Sharpe ratio means an investment is generating more return for each unit of risk it adds to your portfolio. It's a measure of efficiency.
Okay. And how does Bitcoin stack up?
Well, here's the counterintuitive part. Historically, Bitcoin, despite all its crazy volatility, has often shown a Sharpe ratio higher than traditional assets like the S&P 500 or gold, especially over longer time horizons.
Really? Even with the massive swings?
Even with the massive swings. This suggests that, within a diversified portfolio, its inclusion could provide superior returns relative to the risk added. It implies the potential for outsized returns has, historically at least, compensated for that volatility if you have a long enough time horizon and it's part of a broader strategy.
So it could actually make the portfolio more efficient in a way?
Potentially, yes. From a purely mathematical standpoint over certain periods.
Yeah.
It acts as a surprisingly efficient diversifier, not just a high-risk lottery ticket.
Okay, so let me make sure I've got this. We're not talking about going all in. Not even close.
Absolutely not. Strategic diversification, measured, disciplined approach.
But let's make this tangible for you, the listener. How could this seemingly tiny percentage, this 1% to 5%, actually impact your retirement savings over, say, 20 or 30 years? Could it really make a difference?
Oh, it absolutely could be transformative over that kind of time frame. Compounding is incredibly powerful.
Give us an example.
Okay, let's run a quick simplified illustration. Imagine you have, say, a $100,000 portfolio today. And let's assume it grows at a steady, respectable 7% per year on average.
Pretty standard long-term equity return expectation, right?
Right. Over 30 years, that $100,000 at 7% grows to about $761,000. Not bad at all.
Solid nest egg.
Definitely. Now, let's say you introduce a small, carefully managed 3% allocation to crypto. And let's assume, just for illustration, that this strategic diversification manages to boost your overall portfolio's average annual return by just 1 percentage point, from 7% to 8%. Still a reasonable long-term expectation.
Okay, just a 1% bump in the average return.
Just 1%. That same $100,000 portfolio growing at 8% over 30 years, it crosses the $1 million mark. It grows to approximately $1,006,000.
Wow, that's nearly $250,000 difference.
From just a 1% average annual return boost, amplified by decades of compounding, potentially unlocked by that small strategic crypto allocation. It powerfully shows how even seemingly minor improvements in return, sustained over the long haul, can lead to substantially different outcomes for your retirement.
That is genuinely eye-opening. Okay, so that's the long-term investor perspective. But you mentioned it's not just them who are impacted. Even shorter-term traders see something significant here with 401k adoption.
You do, yeah. It's about the market dynamics, the underlying economics.
Yes, so.
Well, think about what happens when money goes into a 401k. Retirement allocations, by their very nature, tend to lock up supply for a long, long time. Decades, usually.
Right, you can't easily take it out.
Exactly. Unlike speculative trading, where assets are constantly changing hands, capital committed to a 401k for retirement, it's generally not going anywhere soon. It's sticky money. So this sustained locking up of assets, especially for major cryptos like Bitcoin and Ethereum, could create a significant and ongoing supply squeeze in the market. Less available supply floating around.
And basic economics tells us.
Scarcity can be a fundamental driver supporting price appreciation over time. If you have a large, consistent pool of capital, effectively removing supply from the active market for the long term, it fundamentally alters the supply-demand balance.
So let's trace that ripple effect. You get potentially millions of retirement accounts consistently buying and holding.
Yeah.
That's increased, steady, long-term demand.
Right. Relatively inelastic demand, too. It's not likely to panic sell based on short-term news.
Okay, so increased inelastic demand meets constrained, locked-up supply. How does your decision or the collective decision of millions to put even 1% or 2% into crypto in a 401k ripple through the wider market?
Well,
Could this actually be that next big bull run catalyst people talk about, moving beyond retail hype or even the initial ETF impact?
it's certainly a very compelling argument for a structural shift in the market dynamics. Think about past Bitcoin bull runs. They were often fueled by specific narratives, right?
Yeah, early adopters, then institutions, futures, ETFs.
Exactly. Early retail, growing institutional acceptance, futures markets, and yeah, most recently, the spot ETFs.
Mhm.
Each brought a new wave of capital. The introduction of consistent long-term demand from retirement accounts could provide an entirely new foundational layer of market support.
A base layer of demand.
A base layer, exactly. Shifting the market maybe from one driven primarily by short-term sentiment and speculation to one with a substantial growing base of long-term holders who are unlikely to sell during dips. That could seriously exacerbate supply scarcity.
Making the available supply even tighter.
Potentially, yes. And this fundamental change in market structure, where a significant chunk of capital is sticky and less reactive, could indeed be a very powerful catalyst for more sustained, maybe less volatile growth over time.
But there's always a but, isn't there?
Huh. Always. It's worth considering the counter-argument, too. More institutionalization, like 401k inclusion, might also attract more regulatory scrutiny.
Ah, okay. Which could.
Could potentially constrain price action in ways we haven't seen before. Or it might attract more sophisticated short sellers who bet against the price. The market's never truly one-sided. It might mute some of that pure supply-demand effect.
Right, a crucial reminder of the complexity. And of course, where there's potential reward, there's always risk, especially with crypto.
Always.
And 401ks, as we said, have their own unique features, their own restrictions that can actually amplify some of those risks compared to a regular brokerage account.
That's a really critical point. It's exactly what the Department of Labor is worried about.
Yeah.
The limited flexibility within 401k is a major risk factor here. Meaning, unlike your Robinhood account or whatever, where you can react instantly, sell, rebalance, maybe take some profits or cut losses, retirement accounts often have strict rules. Limits on how often you can trade, limited rebalancing options, and crucially, big penalties if you try to withdraw money before retirement age.
So you're kind of locked in.
You're pretty much locked in, which means if you experience one of those massive crypto drawdowns, and they do happen, it's characteristic of the asset class.
Right.
Those huge paper losses could genuinely terrify mainstream investors, especially if they weren't properly educated about the volatility going in, or if the option isn't managed with crystal clear communication about the long-term nature.
We've definitely seen those drawdowns. I mean, look back at 2017, the peak, then the crash, or the big corrections in 2021, 2022.
Bitcoin has dropped 70%, even 80% or more from its highs at times.
And while the long-term charts, like that Bitcoin 4-year cycle people talk about, do show recovery eventually.
New all-time highs, often.
Often, yeah. But those short-term drops, they can be absolutely brutal, severe, and incredibly taxing emotionally.
Especially when it's your retirement money.
Exactly. Especially when you know those funds are basically locked up for the long haul and you can't just easily rebalance or pull out without getting hit with penalties. It really tests your conviction, doesn't it?
It tests your resolve in a way few other investments do. That Bitcoin 4-year cycle chart you mentioned, it visually shows that pattern. Huge growth, deep correction, then often new highs eventually.
Tied to the halving events.
Deeply tied to the halvings, yeah. Roughly every 4 years, the rate of new Bitcoin creation gets cut in half, a programmed supply shock. Historically, these supply cuts have often preceded major bull runs. It creates this powerful, though very volatile, boom and bust pattern that long-term investors watch closely.
So the pattern has rewarded patience historically.
It has, but again, that psychological impact of watching, say, 3% of your portfolio, which represents maybe tens of thousands of your retirement dollars, temporarily vanish. That's immense.
It raises that really personal question again. Are you truly prepared for that? For those significant temporary losses, knowing your money is locked up?
What's the psychological cost? How does seeing your retirement savings fluctuate so wildly affect your overall financial planning, your stress levels, your peace of mind?
It's not just about the numbers.
Not at all.
Right.
It requires not just financial understanding, but real emotional fortitude, a very
Yeah.
personal decision.
Thinking about all this deep dive into crypto and 401ks, it really feels like it's about more than just individual portfolios and performance numbers.
Oh, much more.
It seems to have these much broader, almost foundational implications for the whole Web3 ecosystem, for how traditional finance even views crypto. It feels like a real bellwether for institutional acceptance.
It absolutely is, and a critical one at that.
Mhm.
If crypto gains widespread acceptance as a legitimate retirement asset,
Mhm.
think about what that means.
Legitimacy.
Huge institutional legitimacy. It's essentially being recognized not just as, a speculative trade or some fringe digital collectible,
Yeah.
but as a potentially valid long-term store of value
Mm.
and a growth asset.
Moving from gamble to foundational asset.
Exactly. That perception shift is monumental for the crypto industry. It signals a maturity, a level of acceptance that many have been striving for years. It tells the world that major, serious financial players see enduring value here.
And that ties into the kind of research we've seen from firms like ARK Invest, right? Their big ideas, reports talking about Bitcoin in institutional portfolios, long-term wealth strategy.
Precisely. ARK has been very vocal about Bitcoin's potential role. And then you look at a company like MicroStrategy.
Making that huge corporate bet on Bitcoin.
The massive corporate-level long-term Bitcoin bet. Why would a publicly traded company commit billions to holding Bitcoin on its balance sheet, if not for this deep belief in its long-term store of value potential, its potential to outperform inflation, other traditional assets?
They're not just trading it short term.
No, they're integrating it into their core treasury strategy with a multi-year, even multi-decade view. Very similar in principle to how you might think about a long-term retirement holding.
That's a fantastic example of institutional conviction. MicroStrategy is basically treating Bitcoin like digital gold or a long-term growth hedge for its treasury.
Exactly. And that aligns perfectly with the goals of capital preservation and growth that you'd find in a retirement fund context. ARK Invest research even suggests that a small allocation of a corporation's treasury to Bitcoin could improve its risk-adjusted returns over time, similar to our discussion on personal portfolios.
So a big public company doing this lends credibility.
Immense credibility. It argues that Bitcoin, at least, has matured beyond pure speculation for some serious players, that it might have a legitimate place as a long-term store of value, a strategic asset. And that sends a powerful signal to the rest of the institutional world.
Including pension managers, 401k fiduciaries.
Potentially, yes. It gets them thinking, or at least makes it harder to dismiss out of hand.
Okay, let's talk scale again, because the numbers are just staggering. Think about the trillions of dollars sitting in retirement accounts globally.
It's almost incomprehensible.
Right. If even a tiny fraction of that, say 1%, maybe 2%, flows into crypto through these 401k plans, the impact on the crypto market itself could be absolutely massive. An entirely new paradigm of capital inflow.
It really could be. 401k inclusion could systematically onboard millions of new retail investors into Bitcoin, Ethereum, many of whom might never have bothered opening an exchange account or even buying an ETF on their own.
People who just use their default 401k options.
Exactly. This represents a potentially huge new source of consistent capital flows. and it fundamentally changes the market dynamics. It's not just speculative retail money or hot and cold institutional plays anymore.
It's long-term, retirement-focused capital.
Long-term, sticky capital, a slow, steady, but incredibly powerful stream that prioritizes long-term growth, not short-term pops, that fundamentally alters the demand profile for these assets.
So if we compare, say, the ETF inflows we saw, which were huge,
Billions in the first few months, yeah. Groundbreaking.
how does that stack up against potential 401k flows?
Well, think about it this way. A 1% or 2% allocation from millions of 401k accounts happening month after month, year after year through payroll deductions. Over time, that could easily dwarf the initial ETF inflows.
So not just billions, maybe hundreds of billions, trillions eventually.
The potential scale is truly profound. ETFs pave the way, providing that regulated, easy access. But 401ks represent much deeper penetration into the mass market. For many people, retirement saving is almost automatic, an opt-out system.
Set it and forget it.
Pretty much. The contributions happen automatically through payroll. The inherent inertia means this capital will be incredibly sticky, incredibly long-term, and much less reactive to short-term market swings.
Creating a stable base of demand.
An unprecedented level of stable, programmatic, embedded buying pressure for crypto assets that could fundamentally reshape how these markets behave. Maybe even smooth out some of the volatility over the very long term.
Okay, looking even further down the road. What does this all mean for wealth management itself? Are we just adding another asset class to the menu? Or is something more fundamental changing?
I think it could accelerate a really fascinating fundamental shift. The tokenization of retirement products themselves.
Tokenization, what do you mean by that in this context?
It means representing assets, traditional ones or new ones, as digital tokens on a blockchain. So we might start seeing things like crypto-native pensions emerge, or even fully decentralized finance, DeFi, retirement plans.
Wow. So not just traditional funds buying crypto.
Exactly. It's about crypto potentially reshaping the actual structure and delivery of retirement investing.
How would that work? What are the benefits?
Well, for retirement, tokenization could mean, say, faster, more transparent record-keeping of your holdings. You could potentially see exactly what you own on an immutable ledger.
More transparency than today's statements.
Potentially, yes. Or it could enable fractional ownership of assets that are currently inaccessible to smaller investors. Imagine owning a tiny slice of a valuable commercial building or a piece of fine art, all managed securely on a blockchain within your pension fund.
Breaking down barriers to entry.
Exactly, making sophisticated investments potentially available to everyone.
That's a pretty mind-bending thought. Your entire pension, your retirement fund, managed on a blockchain.
It's a big vision.
It could offer, like you said, unparalleled transparency, maybe new ways to generate yield through DeFi protocols, maybe even more personal control over your assets.
Those are the potential upsides. Greater transparency, potentially higher yields through things like staking or lending protocols, maybe more self-sovereign control.
There have to be new challenges too, right?
Oh, absolutely. It's not a utopia. DeFi, while promising, also introduces new risks. Smart contract risk bugs in the code, protocol vulnerabilities, hacks, and frankly, it requires a much deeper understanding of these complex systems right now.
So complexity is a barrier.
It is. The big challenge will be abstracting away that technical complexity for the average person, offering the benefits of blockchain immutability, transparency without exposing them to undue technical risks, or requiring a PhD in computer science to manage their retirement.
Making it user-friendly and safe.
That's the key. But the potential for genuine innovation in retirement planning, enabled by this technology, it's truly immense. It promises a future where your retirement savings could be more adaptable, maybe more efficient, perhaps even more globally accessible than ever before.
Okay, this isn't just like future gazing though, is it? You mentioned Fidelity earlier. There are major players in traditional finance already making concrete moves, big, audacious moves.
Absolutely, not just theory. These are real things happening now. And Fidelity, that was a landmark moment.
Talk about that again. Why was Fidelity's announcement so significant?
Well, Fidelity Investments is just a titan, right? Managing trillions in assets, millions of American retirement accounts, when they announced plans to offer Bitcoin in their 401k platform.
What in some small fintech startup?
Exactly. Yeah. This wasn't the nimble startup testing the waters. This was a venerable, deeply trusted, massive financial institution. It sent an incredibly powerful signal to the entire market.
What was the signal?
That they had conviction, that they were willing to innovate in this space despite the complexities and regulatory uncertainties. Fidelity's press release on this, It was genuinely a watershed moment. It basically gave cover for others to start seriously considering it too, set a major precedent.
And we've seen this kind of evolution happen before, right? Where niche products gradually become mainstream through stepping stones.
We have. It's often an incremental process, building confidence and infrastructure along the way.
Like with the Grayscale Bitcoin Trust.
GBTC is a perfect real-world example. For years, it was one of the main ways, sometimes the only way, for institutional investors, even some retail folks, to get Bitcoin exposure in a traditional brokerage account without holding the keys themselves.
It was a workaround
In a
almost.
way, yeah, a regulated workaround. But then its conversion into a spot Bitcoin ETF, that was another huge step.
Guy, what changed?
It made it even more accessible. Better liquidity, meaning easier to buy and sell. Tighter tracking to the actual Bitcoin price, usually lower fees.
Mm.
And, importantly, it had that full SEC stamp of approval as an ETF.
More legitimacy again.
More legitimacy, better structure. These kinds of developments, from trusts to ETFs, they build the necessary infrastructure. They build regulatory comfort. And that's absolutely essential groundwork for wider adoption, like potentially getting into more complex retirement products.
Okay, so it's not just about what you, the individual, might put in your 401k. This long-term conviction is playing out on much bigger stages too.
That's a critical point. It's happening at the corporate level, even the national level.
MicroStrategy being the prime corporate example.
Absolutely. Making that multi-billion-dollar long-term bet. Holding Bitcoin as a primary treasury reserve asset. That's not a short-term trade. That's a strategic, long-horizon decision. Very much like a retirement mindset.
And then El Salvador.
El Salvador, yeah. An unprecedented move. Adopting Bitcoin as legal tender, yes, but also accumulating it at the state level for their national reserves. A long-term national bet.
These aren't small decisions.
Not at all. They're powerful statements of profound conviction in Bitcoin's future role, made by entities with significant resources and long-term planning horizons.
So if these major corporations, even nations, are making these multi-year, maybe multi-decade bets on Bitcoin, what does that signal to an individual thinking about their own retirement, which also spans decades?
Well, it offers a strong argument for its perceived long-term viability, doesn't it?
It suggests they see it as more than just hype.
Exactly. It demonstrates this deep-seated belief, at least among some major players, in Bitcoin's potential role, maybe as an inflation hedge, a long-term store of value, a unique growth asset separate from traditional markets.
And that influences others.
It can, yeah. When entities with huge resources and research capabilities make these moves, it provides a powerful signal. It lends a layer of credibility that individual investors and potentially those 401k fiduciaries often look for when considering a new or volatile asset class.
Okay, let's circle back to those price swings, the volatility. The historical data shows the swings, yes, but also resilience, right?
It's definitely a double-edged sword, and you need to understand both edges. Looking back at the historical drawdowns 2017-18, 2021-22, you see the massive volatility. No denying it.
70%, 80% drop sometimes.
Easily. But critically, the same historical charts also show the significant opportunity that came with long-term holding through those drops.
Buy and hold even when it's scary.
Historically, that strategy has worked for Bitcoin. While the short-term drops were brutal, the asset has time and again recovered and gone on to surpass previous highs,
Yeah.
often within those multi-year cycles we discussed. That pattern is fundamental to understanding its retirement potential.
And that Bitcoin 4-year cycle chart really illustrates this visually.
It does. It shows the pattern. Massive run-ups, often post-halving, followed by deep corrections, then consolidation, and historically, another run-up to new highs.
So for someone with a 30 or 40-year retirement horizon,
For that kind of time frame, the short-term drawdowns, while still painful psychologically, become less significant in the grand scheme of things. The historical data suggests that patient, disciplined long-term holding, if you can stomach the volatility, has been substantially rewarded.
but the usual disclaimer applies.
Always. Past performance is not indicative of future results. Crucial disclaimer. But you also have to acknowledge the patterns, the underlying scarcity economics from the halvings, the fundamental drivers that have led to this historical resilience and growth.
So invest with conviction, not just chasing hype.
Exactly. Genuine long-term conviction, understanding the risks fully.
Okay, beyond the stories and the charts, what about the hard numbers, the data? What does that suggest about crypto's place?
Well, if you look at metrics like the growth in the total crypto market capitalization over the last, say, 10 years,
It's been pretty staggering.
it's been exponential, far outpacing most traditional asset classes.
Hmm.
Now, that growth might moderate as the market matures. inevitably. But that level of historical growth presents a unique opportunity for long-term capital appreciation that's just hard for retirement planners to completely ignore, especially in a world where finding yield in traditional assets is getting harder.
And comparing ETF flows to potential 401k flows.
Right. That helps project the potential scale. The spot ETF inflows were substantial, making headlines. But they're likely just a preview, maybe even a small fraction, of the much larger, more consistent, deeply embedded capital that could flow in if 401k adoption becomes widespread.
We're talking potentially transformative amounts of capital.
Potentially transformative, yes. Not small numbers at all.
So bringing it back to you, the listener, considering these growth trends, the potential scale of capital, what does ignoring this asset class entirely mean for your retirement planning? Could you be missing out on significant growth, especially if you integrate it carefully, small allocation, diversified portfolio, like the models suggest? It feels like a real question of opportunity cost now.
It absolutely is an opportunity cost question, and a critical one for modern portfolio construction. Prudent risk management is always, always number one. But completely avoiding a potentially high-growth, innovative asset class, especially when showing these signs of institutional maturation and long-term utility.
Might mean your portfolio underperforms.
It could mean your retirement portfolio significantly underperforms what it might have achieved with a well-researched, modest, strategically allocated position. The data points towards a compelling case for at least careful consideration, informed allocation, and ongoing education, not outright dismissal.
Adapting your strategy to a changing world.
That's what long-term investing is all about. Hashtag tag tag outro.
All right, so as we kind of wrap up this exploration, this deep dive, we've really covered a lot of ground on this fascinating, sometimes really contentious idea of putting crypto in your 401k.
You definitely have.
We've seen it's this constant balancing act, right? Significant undeniable risk on one side versus potentially game-changing transformative reward on the other, a real tightrope walk.
It really is. And we've uncovered how this whole movement signals this new era of mainstream adoption. It's being driven by, strong interest from younger generations, but also these pioneering moves by major institutions.
All happening while navigating those tricky, cautious regulatory concerns.
Exactly. It's a complex, multifaceted picture. And the implications go way beyond just individual portfolios or your personal bottom line. It touches the entire financial landscape, the future of wealth management itself.
Our real hope, though, with this deep dive is that it's given you, the listener, some solid knowledge, a more nuanced understanding to help you navigate this landscape as it keeps evolving so fast.
Yeah, it's about equipping you.
Equipping you with the insights to critically and hopefully confidently assess whether crypto in your retirement account is maybe just too risky for you, personally, or if it could actually be a game changer for your financial future.
Considering your own unique situation.
Your situation, your time horizon, your personal comfort level with risk, all of that.
And it really encourages you to ask yourself some key questions now with maybe more clarity. Would you seriously consider adding Bitcoin or Ethereum to your 401k if your company offered it?
And if yes, how much?
Right. How much is the right amount for you? Is that cautious 1% enough? Or if you're younger with decades to go, should you consider maybe a bit more, like 3% or 5%?
Deeply personal questions.
Very important personal questions for your own financial strategy, your future security. And ultimately, only you, armed with good information, can really answer them for yourself.
Okay, so as we finish up, let's leave our listeners with a final thought to mull over, something to chew on.
Okay.
If the Department of Labor's main worries about crypto and 401ks are really about protecting investors, preventing big losses, how might regulations evolve in the future? Can they find a way to both safeguard retirement savers and still allow for beneficial innovation and growth in digital assets?
It's a regulatory tightrope right there.
Could we see new frameworks, maybe clearer rules for custodians, or even specially designed, regulated crypto retirement products?
Or maybe pushing that thought even further. If this trend of crypto integration really picks up speed, will we see the traditional 401k structure itself start to transform?
Or into something new.
Maybe something fundamentally new, more decentralized perhaps, built on blockchain rails to better handle tokenized assets natively.
Wow, and what would that mean for the control you have over your retirement savings in the decades ahead?
And the types of assets available to you. It really opens up a whole new way of thinking about how we build and manage wealth in this increasingly digital age. Lots to think about.
Definitely lots to think about.